Welcome to the Smart Wealth Channel. Today we're talking about index funds, their definition, and investment security. You must be impatient for the video to start as soon as possible, but you need to do something first. That is, subscribe to our channel and turn on the notifications so you don't miss new videos. Do this as soon as possible, and let's get started. We'll start with the definition. An index fund is a type of financial vehicle that pools investors' money to purchase a portfolio of stocks, bonds, and other securities. This portfolio is designed to mimic a particular financial market index, a select group of securities. An index fund can be structured as either a mutual fund or an exchange-traded fund, ETF. The term index fund applies to either, but it's often used synonymously with an ETF since so many ETFs are index tracking instruments. Index funds differ from other funds based on their investment strategy. This strategy is to follow its benchmark or designated market index, generally a broad-based one that tends to perform well over time. When you invest in an index fund, you're buying shares in all the companies that make up the index. Most index funds are weighted by market capitalization, the total dollar market value of a company's shares. That means that these funds usually purchase more of the largest companies in the index than of the smallest companies. The composition of the benchmark index determines the trading decisions of an index fund. By design, true index funds must follow their index. That means there's no room for fund managers to make decisions about which trades to make. Rather than actively picking stocks, they're practicing passive management. Many investors, especially beginners, prefer index funds to individual stocks for plenty of reasons. The main benefits of index funds include 1. Diversification means you'll usually win. Up to 90% of active fund managers underperform compared to their benchmark index, that is, the segment of the market they loosely follow. An index fund provides you with a diversified portfolio of stocks that, as a group, usually do well over time. For example, the Vanguard 500 Index Fund, the one that started it all, has seen a 5-year average return of 11%. 2. They are cost-effective. Diversification can be expensive to pursue by yourself with individual investments. Index funds offer more bang for the buck. A single purchase into its pooled portfolio makes your diversification more cost-effective. Some funds have minimums as low as $1. 3. They are passively managed. Many casual investors aren't interested in managing their investment, they just want to steadily grow their money. Index funds don't require any decisions, so they're great for hands-off investors. 4. They have the lowest costs and fees. Index fund managers don't make any investment decisions, so they don't need to hire researchers or analysts. Those cost savings are passed on to investors through lower maintenance fees and costs. The average expense ratio of an index fund is around 0.49%, and some are as low as 0.03%. Of course, it's important to know why index funds are a safe investment. Are index funds safer than stocks? There are risks with any investment, but your risks with index funds are limited compared to individual stock investing. That's because when a company you're only invested in goes bankrupt, you also lose everything. This is why diversification across your portfolio is so important. But when you're invested in hundreds of companies through an ETF, your chances of going to zero with your investment are almost impossible. It's hard to recreate that diversification when you're choosing individual stocks. But are index funds safe in a market crash? Well, for the most part, yes. If there are big dips or corrections, your funds will also go down. But there's never been an instance where a broadly diversified ETF has gone down and not gone up to higher highs later. If you have a long investment horizon, market crashes are an amazing wealth-building opportunity because you get to buy ETFs at a discount. Know that there will be market dips and crashes, and controlling your emotions when the market falls is just a part of being a long-term investor. Don't sell if you can. If you can accept it will happen at some point, you'll know you can withstand them when they happen. And when an ETF is diversified, it's unlikely that at least some of the companies won't hold their weight in a crash. There are many companies such as AT&T, Chevron, and Target, known as dividend aristocrats and dividend kings, that have proven to be reliably safe bets year after year, despite what the overall market does. As long as your ETF holds some of these companies, you'll likely have the resilience to get through a temporary dip. We hope that you're now a little better acquainted with the term index fund and that you understand its functioning as well as the security of investments. In any case, we look forward to your comments in the section below. Don't forget to like and subscribe to our channel. Also, turn on the notifications so you know when the new video is ready. Well, that's it for today. Have a nice day and see you soon.